In 1636, a single tulip bulb in Amsterdam sold for more than a mansion. Not a field of tulips, not a garden. One bulb, one flower that would bloom for a week and then wither. Men traded houses, land, and life savings for the right to own a particular pattern of petals. Fortunes were made in afternoons. Entire families bet their futures on flowers they'd never seen. And then one February morning in 1637, someone tried to sell, and no one bought. Within weeks, tulip prices collapsed to nothing. The bulb that cost a mansion was worth less than an onion. A century later, England repeated the same madness. Not with flowers, but with shares in a company that promised infinite wealth from trading in the distant South Seas. The South Sea Company became the most valuable enterprise in the world, despite having almost no actual business. These weren't accidents. They weren't isolated manias. They were humanity's first encounters with force more powerful than logic, more contagious than disease, more destructive than war. Collective desire. This is a story of how beauty became currency, rumor became value, and want itself became the market. Before tulips, before stocks, before speculation had a name, there was simply desire, the human need to possess what others want, to hold what others covet, to be envied. The Dutch didn't invent greed when they created the tulip market. The English didn't discover madness when they chased South Sea shares. They simply gave these ancient impulses a new arena, the market. And the market, it turned out, was the perfect amplifier of human nature's darkest frequencies. If you're seeing these patterns for the first time and want to understand how they still shape markets today, hit that like button. And if you're ready to go deeper into psychology behind money, help us reach 1,000 subscribers. We're building something different here. What makes speculation fascinating isn't the money, it's the transformation. Watch how a flower becomes more valuable than food, how a rumor becomes more trusted than evidence, how the collective belief of a crowd can create value from nothing and destroy it just as fast. The tulip mania lasted months. The South Sea bubble lasted a year. But both taught the same lesson, that markets aren't rational systems. They're emotional ones. They don't price assets based on value. They price them based on what someone else might pay tomorrow. And when everyone believes prices will rise forever, they do. Until they don't. Drop a comment telling us where you're watching from and what time it is there. These patterns play out the same way across every culture and century. The mechanics of desire don't change. Let's explore how the first great bubbles revealed something permanent about human nature. Tulips arrived in Europe from the Ottoman Empire in the mid-1500s. They were exotic, rare, and extraordinarily beautiful, especially the ones with broken colors, striped and flame patterns caused by a virus that made each bloom unique. The Dutch, wealthy from trade and eager for symbols of status, fell in love. Tulips became a luxury item for the elite. To display rare bulbs in your garden was to announce wealth, taste, and connection to the wider world. But tulips had a problem as a luxury good. They could be reproduced. One bulb, planted, would eventually produce offsets, new bulbs. Scarcity was temporary. Unless, of course, demand grew faster than supply. By the 1630s, tulip cultivation had become serious business. Growers developed new varieties, each with poetic names: Semper Augustus Viceroy, Admiral Van Enquisen. The rarest bulbs commanded extraordinary prices. But here's where it transformed from horticulture into speculation. People stopped buying tulips to plant them. They bought them to sell them. The bulb became not an object of beauty, but a token of future profit. Tulip futures markets emerged. You could buy a bulb that was still in the ground, wouldn't be delivered for months, and that you'd never actually take possession of. You were simply betting that when delivery came, someone else would pay more than you did. This was new. This was the birth of pure speculation in a mass market. By late 1636, taverns across Holland had become trading floors. Common people, weavers, carpenters, farmers, were trading tulip contracts. Notaries recorded sales. The entire economy became infected with tulip fever. Prices entered a vertical climb. A Semper Augustus bulb that sold for 1,000 guilders in 1623 sold for 5,500 guilders by 1637, at a time when a skilled craftsman earned 300 guilders per year. People sold their homes to buy tulip futures. Merchants liquidated inventory to speculate on flowers. Entire fortunes were converted into promises written on paper, backed by nothing but collective belief that tomorrow's buyer would pay more. And the belief was rational, because every day prices rose. Every seller found a buyer at a higher price. The market validated itself through its own ascent. But markets built on belief have a fatal flaw. Belief is fragile. In early February 1637, at a routine tulip auction in Harlem, something unprecedented happened. A standard lot of bulbs failed to sell, not because the price was too high. The price was typical, but simply because, for the first time, no one bid. The auctioneer tried again. Silence. Word spread through the taverns that night. If bulbs couldn't sell at current prices, maybe current prices were wrong. And if current prices were wrong, maybe yesterday's prices were wrong too. The next day, sellers flooded the market. And suddenly, there were no buyers. Not at yesterday's prices. Not at half yesterday's prices. Within weeks, tulip bulbs that had been worth estates were worth nothing. The market didn't decline. It evaporated. What happened in those months wasn't stupidity. It was a perfectly rational response to a particular set of conditions. When prices rise consistently, buying becomes logical. When everyone around you is profiting from something you're not participating in, abstaining feels like the irrational choice. The Dutch tulip traders weren't fools. They were participants in a self-fulfilling prophecy. As long as everyone believed prices would rise, prices did rise. The belief created the reality, until it didn't. This is the anatomy of every bubble. A real innovation or genuine value that attracts legitimate interest, then a feedback loop where rising prices create their own justification. Tulips were genuinely beautiful and rare. That wasn't the madness. The madness was the extrapolation, the assumption that because something was valuable, it would become infinitely more valuable. That scarcity plus desire equals perpetual price increases. But markets aren't mathematics. They're psychology. And psychology is contagious. The crash, when it came, was just as psychological as the rise. Once the spell broke, once the collective belief fractured, there was no floor. Because the price had never been based on the tulip's utility or beauty. It was based entirely on what the next person would pay. And when no one would pay anything, the asset was worth nothing. Historians debate whether the Tulip Mania was as extreme as legend suggests. Some argue it was primarily a futures market among speculators, not a mass phenomenon. Others claim the economic damage was modest, but the cultural impact was profound. The Dutch Republic, embarrassed, tried to forget it happened. The Tulip Mania became a cautionary tale told in whispers, a collective shame about the moment an entire nation lost its mind over flowers. What they didn't realize was that they discovered something permanent about human nature, something that would repeat again and again in different forms across centuries. The English would learn this lesson 80 years later, and they would learn it harder, because while the Dutch speculated on flowers, the English would speculate on empire itself. And when that bubble collapsed, it would take more than fortunes. It would shake the foundations of political power and reveal that nations like markets could be infected by collective delusion. The South Sea bubble wasn't about tulips. It was about something far more intoxicating, the promise of infinite wealth from distant lands no one had ever seen. In 1711, England faced a problem, massive government debt from years of war. The solution came from financiers who proposed something elegant. Convert the debt into shares of a new company, the South Sea Company. The company was granted a monopoly on trade with South America and the Pacific, the South Seas. In exchange, it would assume England's war debts, paying creditors with company stock instead of cash. It was a brilliant financial engineering scheme. The government reduced its debt burden. Creditors received shares in a trading company with exclusive rights to Spanish colonies. Everyone profited. There was just one problem. The company had almost no actual trade. Spain, which controlled South America, granted only minimal trading rights. The South Sea Company made some voyages, carried some goods, but the business was modest at best. The real value wasn't in trade. It was in the story, and the story was magnificent. Untold riches waiting in distant lands, silver mines beyond counting, monopoly access to markets the world had never seen. In 1720, the company's directors launched an aggressive campaign to inflate the stock price. They spread rumors of spectacular profits. They gave shares to politicians and nobility to create influential advocates. They extended credit, so people could buy shares with borrowed money. And it worked spectacularly. South Sea stock, which began the year at 128 pounds, climbed to 330 pounds by March, 550 pounds by May, and touched 1,000 pounds by August, nearly an eightfold increase in 8 months. The entire English economy became obsessed with South Sea shares. Nobles mortgaged estates. Merchants liquidated businesses. Servants borrowed against future wages. Everyone wanted in. But something else happened. Copycat companies emerged. Hundreds of new ventures launched, each promising revolutionary returns. Some had legitimate business plans. Most did not. One company advertised itself as a company for carrying out an undertaking of great advantage, but nobody to know what it is. It raised 2,000 pounds in a single day. This was a tell. When people invest in deliberately mysterious ventures because they trust that other people will pay more later, the market has stopped being about business and become purely psychological. The crash began in August 1720. South Sea directors, recognizing the unsustainability, began quietly selling their own shares. Word leaked. Confidence cracked. By September, the stock had fallen to 175 pounds. By December, it was under 150 pounds. A year of soaring wealth evaporated in months. The economic damage was catastrophic. Fortunes vanished. Families were ruined. Several prominent investors took their own lives. The scandal reached into Parliament itself. Directors were arrested. Politicians were implicated, and the resulting investigation exposed layers of bribery and fraud. But the damage wasn't just financial. It was philosophical. England had bet on a fantasy and lost. The nation that prided itself on rationality and commerce had proven just as vulnerable to collective madness as the Dutch with their tulips. Tulips and South Sea shares seemed different. One was a flower, the other a corporation. One lasted months, the other a year. But structurally, they were identical. Both followed the same pattern. 1. A genuine innovation or scarcity creates initial legitimate interest. 2. Early participants profit, attracting more participants. 3. Rising prices justify themselves. It keeps going up, so it must be valuable. 4. The story matters more than the fundamentals. 5. Credit expands, allowing more people to speculate with borrowed money. 6. Everyone believes they'll sell before the peak. 7. The peak is only recognized in retrospect. 8. Collapse happens faster than rise. 9. Aftermath brings shame, denial, and forgotten lessons. This pattern is repeated across centuries. The railway mania of the 1840s, where British investors poured fortunes into rail companies that would never lay track. The 1920 stock bubble that preceded the Great Depression. The dot-com bubble of the late 1990s, where companies with no revenue commanded billion-dollar valuations. The 2008 housing crisis, where homes became speculation vehicles disconnected from their utility as shelter. Each generation believes their bubble is different. Each believes their circumstances are unique. And each discovers, too late, that human nature hasn't changed. The mechanics of bubbles are always the same because they're driven by psychology, not economics. Fear of missing out. Social proof. If everyone is doing it, it must be right. The authority bias. If important people endorse it, it must be valid. The recency bias. If it's been going up, it will keep going up. These aren't flaws in human reasoning. They're features. They're evolved instincts that usually serve us well. Social proof keeps us safe. Following authority prevents costly mistakes. Learning from recent experience is adaptive, but in markets, these instincts become weapons of mass delusion. What makes bubbles particularly insidious is that the people inside them aren't wrong in the moment. When tulip prices were rising, buying tulips was profitable. When South Sea stock climbed, buying shares made you money. The behavior was rational given the environment. The irrationality was collective, not individual. Each person made locally optimal decisions that, in aggregate, created a system-wide disaster. This is why bubbles can't be prevented by warning people or teaching history. Because in the moment, the skeptics look like fools and the participants look like geniuses. Isaac Newton, one of history's greatest minds, invested in the South Sea Company early and sold for a profit, then watched the price continue climbing and, unable to resist, bought back in near the peak. He lost 20,000 pounds, a fortune at the time. Afterward, he reportedly said, "I can calculate the motion of heavenly bodies, but not the madness of people." Even genius doesn't protect you from collective delusion, because collective delusion doesn't ask for your consent. It simply becomes the environment you inhabit, and adapting to your environment is rational, right up until the environment itself collapses. The lesson of tulips and South Seas isn't that people are stupid. It's that desire can become its own economy. When people want something because other people want it, you create a self-referential system where value is purely social. The tulip isn't valuable because it's beautiful. The South Sea share isn't valuable because the company is profitable. They're valuable because collective belief makes them valuable. And collective belief can create real wealth until it can't. This reveals something profound about markets. They're not primarily information processing systems. They're desire amplification systems. Markets are supposed to aggregate information and price assets accordingly. But in practice, markets amplify emotions. They take individual desire and scale it into collective mania. They transform personal greed into systemic risk. The price signal, which in theory should guide rational allocation of resources, becomes corrupted by its own feedback loop. High prices attract buyers, which raises prices, which attracts more buyers, which raises prices further, until the day it doesn't. The crash is inevitable not because of external shocks, but because of internal contradictions. The moment everyone owns the asset, there are no new buyers. And if there are no new buyers, prices can't rise. And if prices can't rise, the reason to hold the asset disappears. The tulip needs a greater fool. The South Sea share needs someone willing to pay more tomorrow. When the supply of greater fools is exhausted, the system collapses under its own weight. But here's the darkest truth. We can't stop creating bubbles, because bubbles aren't a bug in human psychology. They're a feature. They're how we coordinate collective action, how we mobilize resources for ambitious projects, how we transform individual risk-taking into civilizational progress. Every innovation boom is, structurally, a bubble. The difference between a productive bubble and a destructive one is simply whether the underlying innovation has genuine value. The internet bubble of 2000 destroyed trillions in wealth. It also funded the infrastructure that built the modern digital economy. The railway mania ruined investors. It also built transportation networks that powered industrialization. Tulips left nothing but stories. South Sea left nothing but scars. But both taught us that human desire, properly channeled, can move mountains, and improperly channeled can become an avalanche. We still chase tulips. We just call them by different names. Cryptocurrencies, meme stocks, NFTs, AI companies with no revenue. The object changes. The pattern doesn't. Because the pattern isn't about the object. It's about us, about our need to believe in something larger than ourselves, about our desire to belong to a collective movement, about our hope that this time, this asset, this story, this moment is different. It never is. The desire breaks, the price collapses, the market resets, and a decade later, we do it again. The Tulip Mania and the South Sea bubble weren't aberrations. They were humanity's first laboratory experiments in mass speculation. They revealed something we still haven't accepted. Markets aren't rational systems. They're mirrors of our collective desires. And desire, unmoored from reality, becomes the most dangerous force in finance. We've had centuries to learn the lesson. We've repeated the pattern dozens of times. And we'll repeat it dozens more. Not because we're foolish, but because the alternative, resisting the collective belief, standing aside while others get rich, being the skeptic who misses a rise, that feels like the greater risk, until the crash. And then we remember, briefly, before the next flower catches our eye. If you recognize these patterns in today's markets, you're starting to see the architecture beneath the chaos. Subscribe to keep following the spiral. Like this if you've ever felt the pull of collective desire, in markets or in life. Comment with which modern bubble you think resembles tulips most closely. And share this with someone who needs to understand that the pattern never changes, only the flower. The lessons are written in every crash, but we only read them between bubbles. The broken desire teaches us that the first currency wasn't gold. It was want, and want, unexamined, destroys everything it touches.